Harsha Upadhyaya is Chief Investment Officer, Kotak Mahindra Asset Management Company. He's with us here. Harsha, thank you very much for joining us. Characterize the environment, Harsha, if you will. Global markets have done so well that you're seeing a bit of a pullback. I mean, I think that's the simplest, maybe the neatest explanation. And I think that encompasses all these, everything which is going into it, into the mix there, right? As far as global is concerned. But here in India, there is optimism. One is this India-US. At some point, it has to happen. Timeline is unclear. And of course, maybe people look for other things to do once, they say, well, maybe too much has gone on into this AI thing. So what do you think? Which way do the scales tilt?
Good morning, Prashant. As you rightly mentioned, I think global equities have done quite well over the last several quarters, and we are seeing a bit of pullback there. Yes, the global macro environment is somewhat different than what India is witnessing at this point of time. So I do not think that we should relate what's happening in the globe and take a cue from there for Indian markets. If you look at Indian markets, the influence of foreign institutional investors over the years has reduced quite a bit. As in earlier, whenever they used to sell in large quantities, market used to show a lot of downside volatility. That's no more true. That's point number one. Second, if you look at India in relation to globe or in relation to emerging markets, over the last year or so, we've seen almost about a 30% kind of an underperformance, which is very, very large underperformance. So to that extent, even if there is a pullback in global equities, I do not think that the current valuations of Indian markets warrant a similar move in Indian markets. And to top it all, we are also likely to see earnings improving over the next couple of quarters and also in financial year 27. That's the expectation currently. So given all of this, I would say that we may not participate on a one-to-one basis with what's happening in the globe of late. However, the upside also will be dependent on, as you rightly mentioned, some of the factors which could impact sentiment, such as a favorable trade deal with US, etc. Otherwise, it's going to be a reasonable market, much better than probably last 12 months. However, it's not going to be anything equivalent to what we saw between 2020 to 24, which was absolutely a phenomenal period for earnings growth, valuation re-rating, all of that. I don't think we should assume that kind of a market is going to come back anytime soon.
Reliance, keep an eye, as I was saying, 15.55. So 15 rupees off the lows on RIL. And, if RIL starts to perform, it'll basically make up for a lot of the other stuff which may be going the other way at this point in time. Market's down just 40 points now. Surabhi.
Yeah, absolutely. I was tracking that. It's looking like the bulls want to fight back. Hi, Harsha. Great to have you with us. Let's talk tech. That's the conversation everywhere around the world, right? And even here in India, because now we've started getting some contrarian buys as well, citing valuations, citing, obviously the cash levels that these companies have, and then the moves that they're making, TCS being case in point. They're taking those steps on the data center front. How are you looking at the large cap IT services space? I mean, do you see it as a defensive fit in the portfolio? Or do you think it'll just keep struggling at low single digit growth levels, so best to keep away?
Surabhi, I think you used the right set of words. You said contrarian buy. I think that's what it's going to be at this point of time. Yes, it has not participated in terms of market moves over the last 4 or 5 quarters. And now there seems to be some bit of a move there. However, nothing has changed on the business momentum side. And still, some of the medium to long-term headwinds that are there for IT services, especially Indian IT services, still continue to be there. And as you also mentioned, the earnings growth trajectory for these companies is going to be much lower than average market earnings growth over the next 4 to 6 quarters. So given all of this, at best, it's going to be a tactical pullback that you will see at this point of time, or a contrarian purchase that you will see from certain market participants. But I would assume that non-IT services would be a sector or a segment to watch where there could be more outperformance rather than IT services itself.
So, sorry, just to complete that, when you say non-IT services, you mean other aspects of technology which are not traditional services companies. Is that what you're saying?
Yes, I mean, you can have selective investment opportunities in internet-based businesses, where there are several businesses which have really scaled up well over the last couple of years. And also, as we forecast their growth over the next couple of years, we do tend to see a lot of growth in some of those companies on a bottom-up basis.
Yeah, Harsha, I'm glad you brought that. That's why I was just clarifying that if that's what you meant, because that was exactly my question, that IT services is not giving you growth. But now you have so many of these internet businesses coming, internet/digital these days, and every new business has a technology layer to it, right? You could be selling, eyeglasses, and there's tech there. You could be a broker, and then there is tech there. There's payments, and then there is tech there. So how do you slice and dice, and where are you comfortable with valuations? I mean, are the valuations still palatable? Because these are very fashionable stocks.
So I don't think you can, paint all of them with a single brush. While all of them use internet to do their businesses, the underlying business strength is something that you need to evaluate. Where there is a larger opportunity size, what's the kind of competition that you are seeing? Are there any entry barriers for a new entrants to come in? What kind of capital allocation some of these companies are doing? So I would say it's going to be purely bottom-up, even in the internet services. Just like what you see in traditional businesses, you cannot paint all the traditional businesses with a single brush. And same thing holds true for even internet-enabled businesses. I think the underlying businesses will determine to a large extent what kind of growth you're going to see in those businesses. And then there is an aspect of how good the capital allocation and efficiency that each of those companies bring in. So net, I would say you need to be selective even in that particular segment. And most of the valuations there are, of course, discounting some of the near-term growth that we are going to see. So it's not that anything is hidden in terms of valuations there. So you need to take a slightly medium to long-term call and stick with it and wait through volatility for all there is in those businesses.
Hi, Harsha. Good morning, and always good to see you in. Harsha, a lot of households, mine included as well, a lot of what you earn starts going into SIPs, into the mutual funds as well. And you're hoping for a brighter tomorrow, 10, 15 years down the line. However, in the near term, the issue has been the kind of supply that you're seeing. And appreciating good businesses is very, very good, right? Whether it's PEs, whether it's promoters, they have put in a lot of heart and soul and build those businesses. But when the kind of IPOs that are coming about, these sort of valuations, it appears that, they are exiting with the money, you're being left with the dream. What do you have to say to this? Because the kind of flow of paper that you're seeing, not in this year itself, but what is lined up in for next year, is very, very excessive. What's your take?
So, Nigel, even when the markets are doing well, there are several market opportunities on the secondary market which may not give you the same kind of returns as some of the others, right? So everywhere you need to be selective. More so in case of IPOs, because generally the offer for sale that's come from some of these IPOs is from either promoters or private equity investors, which means that they are the ones who know the business, they have run the business for quite some time, and they are coming and selling at this point of time. So obviously, knowing the business growth, knowing the internals of the company, they are offering their shares at a particular valuation. So that's where you need to be even more diligent in terms of evaluating some of those opportunities. And if you look at Kotak Mutual Fund, for example, we have been very, very selective in IPO opportunities. And that has worked for us. I think that's going to be the way that you will be able to manage the money. Otherwise, if you buy into all of the IPOs just because there is an IPO and there is an offer for sale, I don't think that's going to work. And if you look at the strike rate of IPOs over the last several years, I think these numbers are very clear and it's in front of you that the strike rate that you see in IPOs over a period of time is much lesser than secondary market opportunity. So definitely there needs to be more cautious stance on IPOs.
Okay, all right. What's the wisdom there? And I think we can all, do with a little bit of caution as well in that side of the market. Harsha, thank you so much for joining in. Good conversation as always. And we look forward to another one soon. Thank you very much.